If you were to ask an investor 5 years ago about Emerson Electric, they probably would have told you about ceiling fans, garbage disposals, and compressor motors. They would have described a classic, reliable, but perhaps slightly boring industrial conglomerate that moved in lockstep with the global economy. A company you bought for the dividend, not for the growth. But if you look at Emerson today, in 2025, that company no longer exists. It has been dismantled, re-engineered, and rebuilt into something entirely different. Today, we are going to tell the story of one of the most aggressive and successful corporate transformations of the 21st century. We have analyzed their annual reports from 2021 through 2025 to track this metamorphosis. This is not a story about motors and fans. This is a story about industrial AI, the software that runs the world's most complex factories, and the hardware that tests the limits of future technology. This is the story of the new Emerson. To truly appreciate the value of Emerson in 2025, we have to rewind to the mindset revealed in the 2021 and 2022 annual reports. Back then, the company was at a crossroads. The world was demanding digitalization and sustainability, but Emerson's portfolio was weighed down by legacy businesses. Management made a bold calculation. To survive and thrive, they had to shrink to grow. They initiated a strategy that terrified some traditionalists but excited visionaries. They decided to sell off their heritage. They sold the climate technologies business, they sold InSinkErator, they sold the thermal disk division. These were profitable businesses, cash cows that had defined Emerson for decades, but they were cyclical, and they were not high-tech. By selling them, Emerson generated billions in cash. The question on everyone's mind was, what will they do with all this money? The answer came in two waves, which we can clearly see defining the narrative in the 2023 and 2024 reports. The first wave was software. Emerson acquired a majority stake in AspenTech. This was a game changer. It moved Emerson from just fixing pipes and valves to controlling the digital brain of the refinery, the chemical plant, and the power grid. Suddenly, Emerson wasn't just a hardware company. It was a software optimization company. The second wave was even more ambitious, the acquisition of National Instruments, or NI. This moved Emerson out of just process automation, like oil and gas, and into discrete automation and test and measurement. This means they are now critical players in semiconductor manufacturing, electric vehicle battery testing, and aerospace. By the time we reach the 2025 annual report, the dust has settled, and the vision is complete. Emerson is now a pure-play global automation leader. The financial implications of this shift are profound. In the old days, Emerson's margins would fluctuate wildly with the price of oil. Today, with a portfolio heavily weighted towards software and high-tech testing equipment, the gross profit margins are structural higher. The floor of the company's profitability has been raised. The 2025 financials show a company that generates robust free cash flow, not just when the economy is booming, but consistently, because their products are essential for efficiency and compliance, not just expansion. Let's dig deeper into the growth engines identified in the latest filings. The first engine is the energy transition, but this isn't just about wind and solar. It's about the messy, complex middle ground where Emerson thrives. It involves LNG, liquefied natural gas, hydrogen, and carbon capture. You cannot transport hydrogen or capture carbon without incredibly sophisticated sensors, valves, and control software. Emerson dominates this space. As the world rushes to decarbonize while maintaining energy security, Emerson is the toll booth operator. Every molecule of clean energy that moves through the new infrastructure likely passes through an Emerson device. The second engine is industrial AI and the Boundless Automation vision. In the 2025 report, management emphasizes that the industrial world is drowning in data but starving for wisdom. Factories generate petabytes of data, but most of it is unused. Emerson's new architecture, powered by AspenTech software and their own smart devices, allows companies to unleash AI on this data. They are moving from preventative maintenance, fixing things on a schedule, to predictive maintenance, fixing things before they break based on AI signals. This saves their customers billions of dollars in downtime. For Emerson, this means recurring revenue. They are not just selling a sensor once. They are selling the software subscription that monitors it forever. The third engine is reshoring and reindustrialization, particularly in North America. The United States is building factories at a rate not seen since World War II. Semiconductor fabs, battery plants, pharmaceutical labs. All of these require the precise test and measurement capabilities brought in by the NI acquisition. You cannot ship a microchip or a battery without testing it millions of times. Emerson is now the gatekeeper of quality for the industries of the future. The 2025 data confirms that their order book is swelling with projects related to these secular megatrends, insulating them from the normal ups and downs of the business cycle. We must also talk about the culture and capital allocation. Throughout the reports from 2021 to 2025, one thing has remained constant: the dividend. Emerson is a dividend king, having increased its dividend for over 65 consecutive years. This is rare. Usually, high-growth tech companies don't pay dividends, and high-dividend companies don't grow fast. Emerson offers a unique hybrid: the safety and income of a dividend king, combined with the growth potential of a tech stock. The management has proven they are disciplined. They return cash to shareholders, but they are not afraid to leverage the balance sheet to make transformative acquisitions when the price is right. However, no investment is without risk. The primary risk for the new Emerson is execution. They have assembled a Lamborghini of a company, now they have to drive it. Integrating huge acquisitions like AspenTech and NI is difficult. Cultures can clash, and synergies can be slower to materialize than expected. The 2025 report shows promising signs of integration, with cost synergies being realized, but the market will be watching closely to see if they can achieve the revenue synergies, selling NI products to AspenTech customers and vice versa. Additionally, despite the diversification, Emerson is still exposed to the global industrial economy. If China slows down significantly, or if there is a global recession, capital spending will pause, and Emerson will feel it. But unlike the Emerson of 2015, the Emerson of 2025 has a software cushion to soften the blow. So, what is the final verdict for the long-term investor looking at the 2025 annual report? The old Emerson was a proxy for global GDP. The new Emerson is a proxy for the modernization of the physical world. They are building the nervous system of the future factory. They are the ones ensuring that the hydrogen economy is safe, that the EV batteries are reliable, and that the semiconductor fabs are efficient. The bust phase of the industrial cycle might scare away tourists, but for those who understand the structural shift in Emerson's portfolio, the current valuation represents a misunderstanding of what this company has become. It is no longer a Rust Belt relic. It is a high-tech titan hiding in plain sight. For investors seeking a blend of defensive income and offensive growth in the age of automation, Emerson Electric offers a compelling multi-year runway.